Hello, I'm Russell Dow, President of Dow Wealth Management, and I'd like to talk to you about the fundamentals of wealth management. More specifically, my presentation is on how my company views the investment landscape and the challenges that investors confront. I will then describe for you how we seek to overcome those challenges for our clients, enabling them to have rewarding long-term investment experiences. First, a few comments about myself and our company. Dow Wealth Management is a closely held, family-owned firm with offices in Falmouth, Maine and Bradenton, Florida, just north of Sarasota. Depending on how we might view the situation, I have either the good or bad fortune of coming from a family that has been especially involved with the securities markets. The Dow family is now in its third generation in which we've devoted ourselves to the investment business. We think it is perhaps a genetic condition. It's our family's all-consuming passion. My grandfather and his two brothers started their careers as stockbrokers back in the 1930s, joining together as Dow Investment Group in 1937, during the Great Depression of all times. In time, they each had sons who joined them, one of whom is my father, Clifford Dow Sr. Much of what I will discuss emanates from what he has taught me over the years. Along with myself, today my father and three brothers are all active in the securities business. As for my personal background, I have an economics degree from Cornell University and a law degree from the University of Connecticut. Despite that background and my business title, when asked what I do for a living, perhaps the best response is that I'm a computer programmer. I founded Dow Software Corporation and have spent much of the past quarter century writing software to help analyze companies' financial data and manage client portfolios comprised of financial securities. A uniqueness of our business is that because it has involved so many family members who have focused on the same subject for so long, our collective effort has enabled us to develop a highly refined investment approach. And that approach has become increasingly supported by substantial technical capabilities, an asset that's critical to successful portfolio management in today's world. Here's what we do. Dow Wealth Management assists clients in the management of their family and corporate wealth in the securities markets. That is our specialty. The management of securities portfolios, which typically include stocks and fixed income investments. Our clients rely on us for advice and guidance to help protect and grow their portfolios. In most instances, we're responsible for most of their investable assets. Their faith in us is an honor, and we take that responsibility most seriously. Our clients include individual investors and their families, corporations, trusts, and nonprofit organizations. In this period of recent financial crisis, the safety of client assets is a common concern. Our accounts are custodied with the Bank of New York's wholly owned clearing firm of Pershing. With over $24 trillion in assets under custody and administration, Bank of New York Mellon is one of the largest and strongest banks in the world. The reason that the investment approach that we advocate tends to be well received, I think, has to do with the fact that Dow Wealth Management invests traditionally. In many ways, we invest as my grandfather invested, while the rest of the financial world has changed its approach, frequently in ways that have not benefited investors, or worse, have caused more harm than good. As I'm sure you're well aware, when we survey the landscape of the financial industry, it's littered with formerly prominent investment firms and investment funds that have gone out of business. That observation alone is testament that many newer investment strategies strayed badly from the lessons of history. The fundamentals of sound investing simply tend not to change with time and so cannot be ignored. Those who have been around long enough know this implicitly. It is also worth noting that the principles of good investing are universal. They apply equally in Europe as in the GCC and just as much in Asia as in the United States. So what I'm going to discuss does not apply only to investing in the U.S., but rather to wherever we might place our money in a free economy. The underlying principles of capitalism and unrestricted financial markets are the same wherever we may be. Dow Wealth's investment philosophy has always been grounded in academics. Our approach is disciplined and reliant on fundamentals rather than any human's predictions or conjectures about what the future may hold. As you'll see later, unlike many investment firms, we don't put our faith in analysts' abilities to predict the future. Although Dow Wealth continues to evolve its investment approach and refine our capabilities, we have always remained true to our roots and focused on our investment principles. A well-honed and rigidly implemented investment strategy that is supported by 76 years of experience in academic research, using 200 years of investment data, has served our family and clients well. Also of significance, being in the business of helping other investors has provided us with a unique vantage point that is not available to the typical investor. Specifically, we've had the privilege to see in detail how many others have invested, some successfully, others not so fortunately. It's fair to say that we've probably seen just about every investment strategy out there. We hope that our in-depth and long-term family involvement with the securities markets has made us wiser investors. It has at least made us more opinionated and dogmatic about what we believe are the good and bad ways to invest. Today, I would like to share with you some of what we Dows have learned. I hope that it will help you become more successful investors and better stewards of your own family's wealth. There are 3 topics that I wish to address. Part 1, the life cycle of family wealth: accumulation, preservation, and the growth of mature wealth. Part 2, defining the investment problem, the Dow Wealth Management analysis. And Part 3, the Dow approach. Now for Part 1, what I like to refer to as the life cycle of family wealth. Because of my profession, people come to me after they've already accumulated sizable portfolios. An observation that's probably not lost on any of us is that the ability to accumulate wealth cannot be taken for granted. Therefore, we can't assume that if we lose a substantial portion of our savings, we'll simply earn it back. Prosperity and dynamic growth opportunities don't last forever, and it can be a decade or longer before the next high-growth period arrives. If we're speaking of family wealth, the individual responsible for creating the wealth originally may have retired or passed on. Consequently, a focus on preservation of wealth must lie at the heart of any long-term investment program. It is also worth noting that the skills used by a person or corporation to amass wealth often are quite different from the skills and knowledge base that will be required to ensure the preservation and further growth of those assets. Therefore, for long-term financial security that might last through retirement, or for generations in the case of wealthy families, it is essential to transition successfully from a wealth accumulation phase to a new phase in which they focus on preservation and growth of mature wealth. Those who get it right ensure the financial security for their retirements and possibly future generations of their families. Those who get it badly wrong just once might never get a second chance. For most investors, as they prosper, the goal of wealth preservation starts to become increasingly important relative to wealth accumulation. At the risk of stating the obvious, growing a portfolio from $1 million to $1.5 million might not greatly improve an investor's lifestyle or sense of well-being. But if he happens to lose his estate and then need to go back to work, he's apt to feel rather distressed. Much of my job then is to help educate our clients about investing, giving them a perspective on how to view the financial markets, to understand the challenges that they are sure to confront, and how to take advantage of them rather than to be victimized by them. Which brings us to Part 2, defining the investment problem. My childhood state of Maine has a rich maritime history, so I'm inclined to use boating analogies. Imagine then that we wish to sail across the ocean. Before we can decide on the type of boat that we're going to need, we first must come to understand the winds and currents, the likely severity of storms that we might experience, how different boat designs might be expected to behave under different circumstances, and how long the trip could take. Only once we have a clear picture can we then construct an appropriate vessel to take us on our journey. Let us assume that at present all we know is that we need a boat that will get us to our destination as quickly as possible, but that it also will minimize the possibility that it will capsize and cause us to drown. Usually these two goals compete with one another. The safest boats tend to be large but slow ocean liners, while the fastest boats are small and light but less safe. So we have a challenge. A successful investment strategy must somehow address both the safety and performance concerns rather than compromise either. In my next section, let me outline for you 8 aspects of the investment environment that Dow Wealth Management considers to be essential to understand in order to design an appropriate portfolio, and a strategy that seems capable of getting us to our destination safely and at a good pace. These are 1. The natural behavior of financial markets. 2. The problem of perceived market trends. 3. The high risk of even seemingly unlikely events. 4. The efficient market hypothesis and the limitations it imposes on investors. 5. A distinction between risk and volatility. 6. The relationship between risk and reward. 7. Two types of irrecoverable portfolio loss that investors must guard against. And 8. The importance of the efficiency of an investment strategy. So let's first start by getting an understanding of how financial markets behave. The real estate and stock markets have, of course, been through a recent boom and bust cycle. So that you don't feel alone, let me show you a few other markets. This is the behavior of the U.S. stock market back in the 1920s and 1930s. And as you can see, there was an enormous rise in valuations, up 467%, followed by a precipitous decline. Here's how low-quality stocks performed in the 1990s and early 2000. This is the low-quality index of the NASDAQ, with an enormous rise followed by a precipitous decline. You've probably heard that gold only goes up. That's what I keep hearing on television. Here's a graph of gold prices in the early 1970s and 1980s. And as you can see, after its decline, it took 28 years before price levels reached their former high. Let's look at another geographic region of the world, the Far East and the experience of Japan in the late 1980s and onward. Here is the Nikkei 225. There's been no recovery even decades later. What we can see then is that large market gains, followed by steep declines, are not all that unusual. In fact, such behavior should be expected. This behavior can be said to be true for all markets, for all time periods, and for all geographic regions of the world. So the market declines recently experienced here and elsewhere are not unique, and they're not a new phenomenon of our modern times. Rather, they have been ever present since trading markets first evolved. If it's not already apparent, let me show you in just one other format how we understand the ever-present dangers of any financial market. All is progressing well, and then a suddenly exploding volcano is the best metaphor that I've been able to imagine for how many investors probably felt as they watched their portfolios come apart during the recent financial crisis. These destructive volcanic eruptions will happen from time to time. This is simply the unfortunate nature of the environment in which we as investors must work. So as we think about how to construct a portfolio, we need to be aware that, regardless of the market in which we invest, eventually it's sure to suffer a devastating crisis. Let me discuss another aspect of these abrupt changes in the financial markets. Sometimes trends can last for exceedingly long periods of time before there's a sharp reversal. It is during such periods that many investors become complacent. They forget how quickly the financial weather can change and how harsh the storms can be. In a sense, then, financial markets almost set traps for investors. As memories of bad times fade, many investors will subject their portfolios to increasing amounts of risk. Consequently, when the reversal finally comes, their portfolios are badly positioned to survive, and therefore they lose far more wealth than what they may ever recover. We might put it this way. If the volcano has been quiet for decades, then someone without the perspective of time might be tempted to build his house on its slopes in order to get a good view. But perhaps he'll get a view he never intended. What we have discussed so far is that the market storms can be severe, but that the upward trends sometimes last so long that we all might be dead before the next calamity. If that is the case, then should we even care about the risk of an economic or market crisis, especially if one doesn't seem imminent? If the skies look clear, maybe we should just set sail and hope for the best. Suppose, for example, we conclude that a severe recession tends to occur just once every 40 years. We might be tempted to believe that this risk is remote and so disregard it. However, if we do the calculation, an event that is expected to happen only once every 40 years means that there is a 25% chance that it'll happen during the next 10 years. Who among us would risk a 1 in 4 chance of being financially wiped out in the next 10 years? Because we are usually working with irreplaceable assets, and because our clients are usually invested with a multi-generational time horizon, at Dow Wealth Management, we take the view that even a seemingly remote risk of an irrecoverable loss is too big for us not to try to guard against it. Long-term investors are sure to confront a storm eventually and must be prepared so as not to get wiped out. Understanding how financial markets behave is an important consideration if we're going to invest in them. If economic crises happen from time to time, why don't we just get out of the market before it crashes? If we see a storm coming, just pull into a safe harbor and wait it out. Certainly that would seem like the prudent approach and would solve all of our foregoing concerns. Let me introduce you to a few guys you might have met before. This fellow says the market's going up. His colleague says real estate never goes down. You can't go wrong with copper. The market's about to crash. Get out quick. And last fellow, the market's going to return 30% next year. These are the guys who make their living telling others what they think the markets will do next, which sectors will do well and which won't. Unfortunately, nobody has such a talent. Here's a simple concept with an elaborate name: the efficient market hypothesis. The efficient market hypothesis states that at any given time, security prices fully reflect all available information. This hypothesis is broadly accepted in academic circles and has been demonstrated to be valid in countless studies. This simple statement has profound implications. Without access to inside information, the current price of a security can only be assumed to be its correct price. It's impossible to know if a stock is underpriced or that a stock is overpriced. Therefore, we cannot predict if a stock price is going to rise or fall in the short term. We cannot predict short-term movements in the overall stock market. We cannot predict changes in interest rates, the inflation rate, or currency exchange rates. We cannot outperform the market sector in which we invest. Depressing, isn't it? We cannot do those very things which, if we could do them, could enable us to create enormous wealth. You may be sure, then, that it is only begrudgingly that we subscribe to the efficient market hypothesis. So this is bad news for us in designing our investment strategy, because we cannot rely on our financial advisor, our neighbor, or the guy we read about in the newspaper to tell us when to get out of the water. Their accuracy is no better than that of random chance. However, we're not helpless passengers on a boat. We can at least select the vessel. There's not just one securities market, but many markets in many market sectors in which we can participate. Selecting an appropriate market and sector are critical decisions. Acceptance of the efficient market hypothesis should not be discouraging. Rather, a big part of being successful in investing is appreciating what cannot be done so that we don't expend time, money, and mental energy in its pursuit, or rely wrongly on our approach only to be disappointed. But are the markets really efficient? My colleagues and I are not oblivious to the substantial and recurring debate among investors about whether the financial markets are efficient. In fact, superficially, there would seem to be much evidence that they're not. Let me comment on that for a moment. Let us suppose that it is possible to predict the future, and that there is some investment professional, some academic, or some investment firm's computer program that can accurately predict future market moves. How then do we go about figuring out who this person or firm is? Or let me ask it another way. If there were such a talent out there, why did so many financial companies across the globe, with billions of dollars at their disposal to find such a person, go belly up? If these companies could not identify such a person, then why should we expect to have any better luck? If you watch the media carefully, the people who are considered to be market gurus change every few years. They have a bad habit of being badly wrong eventually. So please forgive me. I've grown wary of people in my profession who claim to know far more than they really do. Successful investing must begin with a good sense of humility. I don't do my clients or myself any good by relying on claimed talents that just don't exist. Now consider our view of the world. First, we know that devastating market reversals happen from time to time. Second, we cannot even rely on the ability of our advisor to tell us when to get out of the water before a storm. That is a troubling and dire prospect. So what does that tell us about designing and building our boat? It tells us that we had better make it rugged enough to withstand even the rarest of severe storms, because sure enough, if we're investing for decades to come, in time we're going to run across some very bad weather. And if our portfolio capsizes, The family fortune likely will be forever lost because they're rarely ever rebuilt. There are two additional concepts that we think are important to understand when working within the financial markets. These are the concepts of risk versus volatility and risk and reward. Economists have their own definition for risk, but for our purposes, my company defines it simply as follows. Risk is the potential for incurring a permanent loss. Suppose that I invest $1 million into a speculative hedge fund. Shortly thereafter, the fund goes bankrupt and I get wiped out. I'll probably conclude that I had incurred considerable risk. Volatility, on the other hand, is a cause for temporary loss. Suppose that I invest $1 million into a portfolio of blue-chip stocks, which then declines in value to $700,000, but a few years later, it's worth $2 million. I'll probably conclude that the initial decline was simple volatility, and that my risk of an irrecoverable loss was small. When investing, in Dow Wealth Management's view, we hope to minimize risk while being willing to endure volatility. Such investors seem apt to reap considerable rewards while not losing sleep that they might lose everything. Enduring market volatility is not desirable or pleasant. However, in theory, capitalism must pay greater returns to such investors, or no one would ever expose his capital to such fluctuations in value. Another boating analogy might help to clarify the difference between how we perceive risk and volatility. In our desire to cross the Atlantic Ocean, suppose that we have the choice between two vessels. We can take a speedboat or we can travel by ocean liner. If the seas are calm, the speedboat will get us to the shores of the UK in a few days. But if there is a storm, we'll all drown. On the other hand, if we take an ocean liner, our travel will be slower, but the storm will only cause us motion sickness. We're relatively assured that we'll reach our destination. Those who travel by speedboat expose themselves to risk. Those who travel by ocean liner expose themselves to volatility. Most investors can usually find temporary volatility to be acceptable. The risk of permanent loss is obviously not. You probably have all heard that risk equals reward. In other words, if we want a higher return on our investments, then we must take greater risk. This has become the expectation of many investors. The implication is that if we risk our money, we deserve higher compensation and will eventually get it. At Dow, we consider that view to be nonsense. If that were the case, then no one would ever put his money in anything but risky investments, since they would in fact not be risky. There seems to be a sentiment that risk can be adequately addressed by broad diversification. In other words, we might own a large number of risky investments. In this manner, even if a number of them suffer irreversible losses, the others might be prospering, giving us an overall positive experience. This is Dow Wealth Management's view on risk and reward. High risk generates high returns for some investors sometimes. Or to put it another way, sometimes all high-risk investments collapse at the same time, so that diversification among them does not do any good. So let us remember, high risk does not guarantee high returns. When we think about wealth preservation, we need to be aware that there are two ways that we can suffer irrecoverable losses. The first is the loss of our principal. As previously stated, if we invest $1 million in a fund and it goes bankrupt, there is no hope of recovery. The second is the loss of our principal's purchasing power due to inflation. Suppose that an investor places $1 million in a safe deposit box. Our investor might believe that he can sleep well at night. He is assured that his money is secure and available to him whenever he wants it. We say, however, that although the investor's principal is safe, he has merely taken on a new kind of risk. In fact, he probably shouldn't sleep well at all. The great risk borne by the investor is the safety of his purchasing power. Today's dollar, euro, pound, or other currency surely will not be as valuable 10 years from now. Because of inflation, they won't be as valuable even 1 year from now. Using constant dollars at a 3% inflation rate, the purchasing power of $1 million erodes to $740,000 in 10 years, a 26% loss of purchasing power. At a 10% inflation rate in just a decade, $1 million would be worth just $350,000 in today's currency. What have we accomplished then if we succeed in protecting our principal, but after a few years it buys much less than it does today? Moderate inflation is always a problem that we have to guard against. From time to time, countries experience what is known as hyperinflation, when the inflation rate exceeds 50% annually. That kind of event can wipe out a fortune literally overnight if one is not protected against it. So I want to dispel the notion that paper money is safe. Here is a list of countries that have experienced hyperinflation. Historically, globally, even this worst of the worst is not exactly uncommon. During the recent financial crisis, many investors fled to cash thinking it would afford them good protection against loss. In many instances, they could be in for a surprise. Ultimately, cash is only ink on paper or an entry on a computer screen. Governments routinely devalue their currencies, and sometimes they devalue them quickly. Some examples: a 1 million mark note from Germany, 1924. A 10 million pengo note from Hungary, 1945. A 100 dinar note from Bosnia in 1992, devalued to 0.1% when the government stamped 3 more zeros on them. Yugoslavia issued a 500 billion dinar note in 1993. Not to be outdone, Zimbabwe issued a $50 trillion bill in 2008, followed by a $100 trillion note that I purchased off eBay for a few US dollars. If our president would print just a single such bill, he could pay off the $15 trillion US debt 6 times over. The loss of our investment's purchasing power can be every bit as devastating to our portfolio as would be the permanent loss of principal. In structuring an investment portfolio, Dow Wealth Management's view is that if we're to be successful in preserving our wealth, we must have an investment approach that guards our portfolio against a permanent loss of principal and an erosion of its purchasing power, and the strategy must accomplish both of these goals simultaneously. Why simultaneously? Why don't we wait to adopt an investment strategy that guards against inflation until just before it becomes a problem? Because we must assume that quickly accelerating inflation cannot be predicted either. Therefore, if we wait to take action, the damage may already be done before we realize just how bad the problem is. Now let me discuss the last of the 8 elements. Over the years, we have observed that many investment products badly underperform the markets in which they invest. For example, during a period when the stock market rises 25%, perhaps a mutual fund underperforms it and earns just 20%. Or if the market falls 15%, the mutual fund declines even further, tumbling 20%. In other words, the fund earns less during the good years and it loses more during the down years. During prosperous times, many investors don't even notice the underperformance because they're earning high returns even despite the costs. Investors tend to be dismissive of high costs when they're making money. Unfortunately, as investors continue to suffer the high costs of an investment program during a stagnant or declining market, their overall investment experience can prove to be dismal. In this table, we assume $1 million is invested in a mutual fund that has embedded costs of 5% annually. Therefore, with the stock market going up 25% annually after 5 years, giving a $2 million return, the mutual fund investor making 20% annually ends up with a $1.5 million return. But now assume, as happens, the bull market ends and the market stagnates for the next 5 years. The stock market, generating 0% for the next 5 years, still leaves us with $2 million, while the mutual fund investor, losing 5% annually, now sees his $1.5 million decline to $900,000. And so, referring back to the efficiency of portfolio design, an essential criterion of a successful portfolio experience is to be aware of and avoid investment products and strategies that have high costs. And we need to be aware of these costs even during periods when profits come quickly and expenses merely appear not to matter. We simply can't justify giving away a large portion of our investment returns during a bull market stage, because we therefore would not have earned enough to sustain the portfolio during periods of famine. Or to use another boating analogy, we don't want to build a perfect boat only to be slowed down by dragging the anchor. This, then, is the animal that Dow Wealth Management believes we must tame in order to improve our prospects for being successful investors over the long term. We must be able to design a portfolio that addresses these critical problems and that functions well within the dynamics it'll confront, while recognizing our own inherent limitations. There is no magic. So far, then, I have not painted a very encouraging picture for us. However, it is only by first understanding the dynamics of investing and the nature of the financial markets that we then have a possibility of finding a way to work effectively within them. Now I'd like to describe for you how Dow Wealth Management approaches this investment challenge. We're now ready to design and build a proper boat for our voyage, one that'll get us to our destination both assuredly and at a good pace. At first glance, it might appear that any design that addresses all of the foregoing will need to be complex with lots of moving parts. Let me illustrate for you how I view the intricacy of some people's investment strategies. A visual analogy of overcomplication. In my mind, this is a portfolio that tries to time the markets, futilely rotating from market sector to market sector. It's a portfolio that uses what I call buffet investing. It invests in some of everything. It's the kind of portfolio that suffers from unnecessary costs caused by the friction of multiple layers of portfolio management and product investing. Fortunately, a recurring hallmark of a successful investment program is that it tends to be simple to understand, and simple to implement. Now let me illustrate how we view our own investment approach. Simple and direct. In our view, an investment approach that takes a rocket scientist to decipher probably has something wrong with it. Or more cynically, the investment strategy is hiding something from the investor, usually high fees and high risk. In fact, investment success often is highly correlated with simplicity of design and execution. So let me caution you against what are often marketed as sophisticated and hard to understand investments by our industry. They have a depressingly high rate of catastrophic outcomes for their investors. Let's start with the most critical design element of this boat that we're constructing: avoidance of an irrecoverable portfolio loss. Because as we have said, the first priority of an investment strategy must be the preservation of wealth. We have identified two ways that our portfolio might get sunk. We can see our purchasing power erode because of inflation, or we might simply make a bad investment that becomes worthless. Let's first address the need to preserve our portfolio's purchasing power. Inflation usually won't damage a portfolio quickly. Even so, inflation is like a constant wind pushing us backwards. A decade from now, when we go to spend the funds, they won't buy nearly as much as they will today. One way to address the problem of ever-escalating consumer prices is to own assets for which their replacement cost rises because of inflation. Inflation means that it will cost more to rebuild our homes years from now, and it means that it will cost more to rebuild an office building. So if we own a house or a building, then even if we suffer through a period of high inflation, we might expect such assets to appreciate similarly. Ownership of equity, therefore, does something that cash in our wallets can't do. It can act as a hedge against inflation. In this regard, it probably doesn't much matter what kind of equity we own. We might own real estate, commodities, valuable paintings, or the common stock of corporations. With these kinds of assets, a depreciating currency means that it will simply take more currency to buy them. Our equity form of choice is common stocks. That is the form of equity that Dow Wealth Management uses in its clients' portfolios to help guard against inflation. When we own stocks, we own companies that in turn own factories and office buildings. They own patents and name brands. They own organizations of workers and client relationships. They own infrastructure. If we had to go out and replace those assets after an inflationary period, it would cost more to do so. Consequently, over time, stock prices tend to increase along with inflation, providing a measure of protection for shareholders and hence for our clients. Equity, of course, is a pretty broad classification. There are seemingly an infinite number of different forms of equity, but is a good start at defining our investment strategy. We still have the concern of an irrecoverable loss of our principal. As we saw at the start of the presentation, all financial markets and economies should be expected to suffer painful setbacks from time to time. Furthermore, we've learned that we probably cannot rely on anyone's ability to predict the next market crash in order to save us from financial disaster. We don't want to crash on the rocks just because we have an overconfident captain who proves to be badly wrong from time to time. If we cannot depend on a system to warn us of the coming financial hurricanes so that we can steer around them, then the only alternative is to build a vessel that is capable of taking the storms head on, especially rare major storms. We need a boat that has a sturdy hull. In terms of an investment portfolio, we accomplish this design criterion by building portfolios using high-quality securities. But what does high quality mean? A high-quality security is one for which it seems unlikely that the underlying company will go bankrupt, even during the worst of times. The ownership of high-quality securities may not be important during good economic periods, but they can be essential in helping to insulate a portfolio against catastrophic events that occasionally befall our economy. How do we determine the quality of a stock? For some people, quality is synonymous with the company's size and visibility. Dow Wealth Management's definition of high quality is much different. For us, high quality means that the underlying company has a strong balance sheet, a strong income statement, and furthermore, it means that the company has a long history of making enough money to pay its liabilities and dividends. In other words, any two people schooled in finance should be able to agree on whether a company is of high quality or low quality. This is not a matter of personal taste like deciding if a work of art is beautiful or simply a can of soup. If a company has a lot of debt, we do not buy it. If a company is losing money, we don't buy it. If a company does not have a long history of good and consistent earnings, we don't buy it. That is a fundamentally important step in trying to protect our portfolios from suffering a permanent loss of principal. In fact, I would suggest that it's our only reasonable hope, since we know that no one can predict with certainty the next economic crisis or market decline so as to avoid it. The best we can do, then, is to be prepared for the storm whenever it might arrive. To give us an even greater measure of protection, we don't place too much money in any single company. Rather, we broadly diversify the portfolio among a large number of high-quality stock holdings. Such a discipline helps ensure that, however severe the storm may be, the boat most likely will never sink. As a rule, we typically invest at least 80% of a client's portfolio in a diversified list of high-quality securities. Remember, we define risk as the potential for incurring a permanent portfolio loss. And as best we can in structuring our clients' portfolios, Dow Wealth Management tries to eliminate as much risk as possible. If someone owns a diversified list of the highest quality companies in the world, the odds seem reasonably good that his boat is going to stay afloat. He can probably go to bed at night and not concern himself that he may need a life vest. He would seem to be well protected against an irrecoverable loss of his principal. Even if there is an economic depression, the company's own would appear to be well suited to survive it. And if inflation takes hold, the equity characteristic of the portfolio would help preserve its purchasing power. Now it appears that we might have a theoretical investment problem. What I've just described seems to contradict the most enduring and immutable rule of investing. You may well have heard of it. It goes like this: there's no such thing as a free lunch. In investing, neither lunch nor dinner ever comes for free. And sadly, not even breakfast toast. What does that mean? It means that if we expect to earn an investment return, then we must pay a price. We must make some sacrifice. And the better the lunch, the higher the sacrifice. That seems to make sense. No one is going to pay us investors for doing something that's painless to do. If our investor with his broadly diversified portfolio of high-quality stocks isn't taking any appreciable risk, then why should he expect to earn much of a return at all? The reason is that, even though we have largely eliminated risk of a permanent loss, we still have not eliminated volatility from the portfolio. If he is invested in stocks, our investor must endure the rise and fall of the market. That is the reason the markets will tend to pay us a good return. Nobody inherently likes the volatility of his portfolio. No one likes to risk getting seasick. Technically, what the market is paying the investor to do is to suffer the uncertainty of not knowing when he'll have a permanent investment gain, or how much that return will be. By giving up control over the timing of our returns and the certainty of the amount, stock investors have tended to be well rewarded. So we do not look upon volatility as a bad thing. It's merely an unavoidable aspect of stock investing. In Dow Wealth Management's analysis, the trade-off of higher volatility for the potential of a higher return can be a very good one. Dow Wealth Management takes the return for enduring volatility one step further. There's a certain type of company that tends to be more volatile than others. The type is a growth company. A growth company is one whose earnings are increasing at above average rates, but also have somewhat higher price-to-earnings ratios and higher betas. If we're willing to endure the even greater volatility inherent with growth stock investing, then we might improve our expected returns. Growth companies tend to be agile businesses that maximize opportunities. Currently succeeding companies tend to have the ability to reinvest in their own futures to promote still more growth. These are the companies that tend to be at the forefront of their respective industries and are recognized as market leaders. An unavoidable characteristic of growth stocks, however, is that the trade-off for their greater total return potential is even greater volatility than what we would find with common stocks in general. As I said, there is no free lunch. If we're not paying a price in terms of a risk of permanent loss, then high-quality growth stocks make us pay in terms of their greater price fluctuations. To put the matter in terms of our boating experience, we could build a boat so large that we wouldn't even feel the waves. If we did, it probably wouldn't go any faster than a cargo ship. But we can probably build a smaller, faster boat that is equally as rugged and no less likely to sink in a bad storm. With a smaller boat, we'll feel the waves and maybe even get seasick at times when the going is especially rough. However, we should expect to make far better time in reaching our destination. The investment portfolio that we've designed is characterized by the ownership of a broadly diversified list of high-quality growth companies. And our investment strategy is to own this portfolio throughout all market periods because we know that it's futile to try to time the markets. As we've seen, if high portfolio expenses cause us significantly to underperform the markets in which we invest, we won't have a very rewarding investment experience. When my grandfather entered the investment business in the 1930s, there were predominantly only two types of investments that people owned: stocks and bonds. Most securities investors owned one or the other, or some of both. Today, however, the financial services industry has created a vast array of investment products. By investment products, I mean mutual funds, commodity exchange-traded funds, hedge funds, insurance products, real estate investment trusts, unit trusts, and the list goes on. Investment products, however, are never anything more than a package that holds equity, debt, or some derivative of them. They're merely a container. So to take IBM stock, for example, there are two ways to own it. One, we could buy an insurance product that invests in a mutual fund that in turn buys IBM. Or two, we can simply buy IBM shares for our portfolio. The first way is indirect investing. The second is direct investing. The first way is frequently enormously expensive. The second is highly efficient. The costs associated with product investments like mutual funds are both explicit and implicit. In other words, some of the costs are stated in the prospectuses, while other costs are hard to find. One major explanation for the underperformance of funds is due to a concept called market impact costs. For those who are interested, Chapter 9 of my dad's book elaborates on the subject. One way to characterize mutual fund investing, among other such product investments, is to use our anchor analogy. It is as though we were to design the perfect high-performance boat and then race it while dragging the anchor. Mutual funds were originally designed for investors with limited means who wanted to invest a few $100s each month. They couldn't afford to buy a diversified portfolio of individual stocks as wealthy investors did. Unfortunately, over the past 3 decades, the financial industry has heavily marketed product investing because it's so highly profitable for the industry, not for the investor. Investment products are now sold to the well-heeled and those of modest means alike. For investors with sizable portfolios, however, there is simply no need or even justification for the indirect ownership of their securities. To illustrate the point graphically, those who own their securities outright tend to enjoy higher rates of return as compared to those who utilize the product approach. A successful portfolio design will place us on the more efficient path. By recent example, in 2011, the S&P 500's total return was a positive 2%. The average U.S. equity mutual fund returned negative 3% before sales fees. 5 percentage points of investor return forever vanished. In short, Dow Wealth Management's view, funds have no place in serious investors' portfolios. They certainly are not needed and often are the cause of chronic and debilitating underperformance. What about these guys? What do they tell us about our portfolio strategy? What does it mean that every once in a while a rare storm will likely come upon us so quickly and with such vigor that it will sink unseaworthy vessels? And what does it mean that we cannot even rely on the weather reports for an accurate forecast? It means that our investment strategy must remain defensive at all times. For example, we can't abandon high-quality securities just because the economy looks like it's improving. There may be a surprise around the corner. So we cannot time the markets. We cannot risk owning predominantly low-quality securities even for short periods of time for fear of being caught unexpectedly. In other words, just because the weather looks good today, it still probably isn't a good idea to head out across the ocean in a canoe. Now to conclude. We started by defining our overriding investment objective as the preservation of wealth. While we probably all agree on the paramount importance of this objective, by many investors' behaviors, I have often found that they appear to be oddly unfazed by its significance to their well-being. More likely, however, they tend to be naive about the risks inherent in the markets in which they invest. Consequently, they may unknowingly jeopardize their financial futures. Lessons are often learned after it's too late. But as we have done in this presentation, by understanding the natural behavior of the financial markets and our limitations as investors, by defining the risks and costs to which we should be unwilling to expose our portfolios, and while accepting that market volatility can be an acceptable trade-off for a higher total return potential, it is possible with thought and purpose to craft an appropriate and potentially rewarding investment strategy. Let me illustrate where we are qualitatively and numerically with a table. We craft our portfolio by focusing on the levels of risk and volatility to which we are willing to expose our assets. The first row is the level of risk of an irreversible portfolio loss. The second row is a measure of portfolio volatility. And the third row is a projection of the possible rate of return to be earned in exchange for the volatility that the investor might endure. Now we can highlight several market sectors in which we could invest. These market sectors are characterized by the quality and growth attributes of the underlying securities. Cash deposits, of course, tend to be very high quality, but are slower growth assets. They have very low risk of loss. They don't fluctuate in value. 3% might be an expected rate of return. At the bottom of the chart, we see that over 20 years, $1 million invested at 3% annually would give us an $810,000 profit. Next, let's add a portfolio of high-quality stocks. Here again, by design, the risk of permanent loss was seen to be nominal. However, we incur much greater volatility in the portfolio's value. For enduring that motion sickness, the market might pay us 10% annually. In dollar terms, over a 20-year period, that would amount to nearly a $6 million profit. Now let's modify further the types of companies we own. Instead of randomly buying high-quality companies, let's focus only on those that qualify as being growth companies as well. Again, by owning an array of companies that are leaders in their fields, that have strong balance sheets and healthy income statements, it seems doubtful that we'll ever suffer permanent loss of principal. On the other hand, because of the nature of growth companies, our measure of likely volatility has increased still further. What might we get for suffering the greater volatility? We would expect a few extra percentage points in average annual earnings. At a 12% rate over 20 years, we would earn about $3 million more, or nearly $9 million. As you may recall, earlier I mentioned that Dow Wealth Management typically invests 80% or more of a portfolio in high-quality securities. That still leaves us with up to 20% that we have not yet addressed. I've added one more column to our chart. This column highlights a category of stocks that are of particular interest to us, and it's how many of our clients allocate a modest portion of their portfolios. Aggressive growth stocks are those that are not high quality, but whose underlying companies are growing at exceptionally high rates. For investors interested in the potential for even more dynamic appreciation than what high-quality growth stocks might offer, such issues may live up to expectations. However, as we will notice, going back to our most fundamental rule about there being no free lunch for investors, such stocks expose the investor to even greater volatility. The payoff, however, for such stocks can be especially good. At an assumed 15% rate of return compounded over 20 years, the investor would earn $15 million. But remember our volcano. As attractive as that rate of return might appear, note that our level of risk also has increased. It is for this reason that we carefully limit such holdings to a minor portion of an investor's overall situation. But now for the all-important question. What will our rate of return actually be? Will we earn 10%, 15%, or 25% next year? Or lose 15%? We cannot know. That is the unsatisfying but correct answer. Dow Wealth Management's approach is to control for risk and volatility in a portfolio. Then we accept that our rate of return will be dictated by the market in which we're invested. What we can say is that if we expose our portfolios to an investment philosophy as I've described, directly owning a broadly diversified portfolio of high-quality growth stocks, the odds seem much in our favor for doing well in the years and decades ahead. So finally, let's take one last look at the challenges we face as investors and the strategy that we have designed to address them. So here are the 8 elements that we need to address for a successful investment experience. To continue with our nautical analogy, here is a sea that we must navigate. And here is the boat that we have designed to provide a safe journey and one that seems likely to move us ahead at a good speed. And for those who like to supercharge the engines, then a modest exposure to aggressive growth stocks offers the potential for making their investment experience more dynamic and even faster paced. By observing the investment principles discussed, you should leave 90% of your fellow investors in your wake. I wish you fair winds as you navigate your portfolio to ever higher returns. I'm Russell Dow. Thank you for your time.